Curious as to your assessment of changes of interest rate scenarios and the risk to earnings and cash flow by a change in the shape of the yield curve or the level of rates.
ASB has a long positive duration gap on their balance sheet. That's why we think ASB is facing an interest rate risk, a rising interest rate risk. However, we think the interest rate risk impact is minimal. First, because ASB has a large low-cost deposit base, and the major deposit base is non-interest-bearing deposit and fixed-rate savings, and they're relatively inelastic to a rising interest rate. On the other hand, ASB also has trying to reduce their long duration gap by selling their residential loan and try to minimize the impact of the rising interest rate. And also management perform a sensitivity analysis on their loan portfolio, and if interest rate actually go up by 100 basis point, the net interest income is only going to decrease by 0.4%. Sorry.
Also, given the current monetary environment, we feel it is unlikely that the Federal Reserve would raise short-term interest rates anytime soon. They've made their commitment that should economic conditions warrant it, they will keep rates low through 2014. And current low levels of resource utilization with high unemployment and subdued manageable inflation indicate that the Federal Reserve will be keeping interest rates low.
I'm interested in hearing about the growth CapEx. How much of that is being mandated by state programs to diversify away from fossil fuels? What's the nature of some of these investments they're going to make? And what could go wrong with these investments that they make, with the expenditures in the next few years?
Definitely. One of the key classifications that we kind of assign to the growth CapEx is it is large projects pending legislative approval. These are the high-risk projects compared to the current maintenance projects. What we see with the high-risk projects is that while normally like traditional growth CapEx, it will drive revenue, at the same time, because it's of alternative energy, it's going to make demand decline at the same time. That's part of the reason we consider them growth neutral, because the two effects could potentially cancel each other out. That, and we cannot model large projects that are still pending heavy legislative approval with kind of a good conscience. Many of our maintenance projects that are still in are kind of infrastructure and grid related. These are the undersea cables and that sort of thing that are required to put this alternative energy into operation.
Tell me about your opinion of management, and if you want to break that into two parts, go ahead.
The management for HECO, especially in the utility industry, is extremely important because you need to invest in human capital. There's not that much to go around, and you need to have the right people in the right spots. Management in HECO will split it into two classifications, the board of director and the executive board. The executive board in particular has been pulled from a variety of utilities in a variety of different environments, whether on the mainland or on the islands itself, promoted from within. The executive board has the experience that HECO needs, and it also has the compensation schemes that support that. They're subject to a variety of goals to meet compensation above their base salary. These can be anything from meeting alternative energy benchmarks to just going out and making sure that customers are happy. The board of directors, on the other hand, is a majority of independent boards of directors from a variety of different industries, both local and mainland.
You mentioned a couple times about the regulatory backdrop and how they will respond and obviously work out very well if the regulatory backdrop doesn't change. How would you assess the potential risks that we would have? It is a political process, that it changes somewhat, and what would be their ability to move with great flexibility if that happened?
Well, one of the major risks that we see in this new regulatory scheme is that electricity rates are going to be expected to rise, and that could lead to customer dissent. So to mitigate that, one of the major things that they can leverage is the fact that the PCAOB is making a huge push towards environmental or sustainability reports, which is basically an environmental supplement to the financial statements. And essentially, they're going to be able to score high on environmental metrics and essentially benefit from positive press. So basically, the state of Hawaii, as well as its people, are fully behind the regulatory body and the foray into alternative energy.
Moreover, as we invest in more and more local renewables generated in the state of Hawaii, the people of Hawaii will be gaining jobs and income. This is spending in the state of Hawaii. Consumers will be more willing to spend higher on their electricity rates if they know that the money will stay in the state going to local people and compared to being exported for foreign oil.
Also, to conclude, I'd like to note that compared to a lot of other areas, Hawaii has a large wealth of untapped alternative energy resources. We've got about 800 megawatts of potential for geothermal on Big Island alone. This could power Oahu, which is the majority of demand for energy, 3 times over. We've also got a surplus of wind and solar power.
So you spoke about some funding requirements based upon their growth CapEx. Do you think they'll have any difficulties in raising that? What are their challenges? And do you think they should change their capital structure at all?
I think it's one of the worst ideas that the utility could have to try and change its capital structure. That's one of the things that it needs to pay attention to while it's doing all of this financing in order to preserve its BBB- credit rating. This BBB- credit rating is not under watch, but I know that management is cognizant of it and that they're keeping that in mind as they pursue additional financing. As far as pursuing financing, the utility has the benefit to operate closely with the Hawaii State Municipality, and they can fund through special purpose revenue bonds and get a potentially lower cost of capital.
Compared to Bank of Hawaii, ASB seems to be doing a good job at managing their loan loss situation. Is ASB, in your opinion, a way for the company to grow versus the spin-off option that you mentioned? And if you could just talk a little bit about how you came to this conclusion that a spin-off was even possible. Is this something the company's talking about?
We feel that the utility side and the bank side has no direct synergies whatsoever in terms of business model or regulatory. There are 2 different regulated entities, so they share different capital structures, they share different business models, so there's no synergies. On the bank side, we believe it will operate significantly better if it were to be bought by a mainland bank, such as Wells Fargo or Union Bank. Because we feel that a bank such as their scale could utilize their scale to synergize with American Savings Bank to develop into to increase their loan capacity, which is something Bank of Hawaii benefits over ASB because it has significant scale, and that allows them to be safer and etc.
Furthermore, we came to the conclusion of a potential ASB spinoff because the current capital structure, we believe, is destroying value to the conglomerate. As we've mentioned, in North America, conglomerates trade at a 10% discount, and which is why we introduced this possibility, which would provide 2 major benefits. 1, pure play bank and utility investors will be able to focus their investments, as well as management will be able to focus their strategies with respect to dividend policy, capital structure, etc. Furthermore, even though they may not have explicitly stated it, a recent Hawaii example of this would be Alexander & Baldwin. The Matson Shipping Company recently spun off Landco, which is their properties division, which resulted in an instant 20% spike in their stock price.
If you happen to be wrong with your buy recommendation and stock price, why will you be wrong?
If we're going to be wrong, it's probably because, as we've been hearing, the concept of a dividend bubble. Well, a dividend bubble in whole, you're still getting a dividend yield that is 2, perhaps 3 times what you can see for treasuries right now. And it's based off of safe, stable operating cash flows tied to a stock that doesn't have the layers of transparencies that you can see from mutual funds, as well as being tied to an equity that can add diversification to a portfolio. As far as being wrong, utilities have never had too much in the way of price fluctuation. That's why they're considered the quintessential widow and orphan stocks per se. We think that the majority of utility investors, they're going to buy in the dividend yield. Price appreciation, it's limited.
Another factor is that we believe the current banking valuations are very depressed because of the European crisis and the mainland mortgage-backed securities. However, American Savings Bank has no correlations with that. And we believe if the banking environment does not improve within a year or within 2 years, then American Savings Bank's value would be undervalued because it is technically, well, analysts haven't been paying very much attention to its true fundamental value.
What is your time horizon?
Our time horizon for our model is looking out to 2016, but with all good analysis, fundamental analysis, we're